Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, I'm Brian Overby, the Senior Options Analyst at Ally Invest. Well, today on the Stock Play of the Day, we're going to eventually look at Twitter ahead of their earnings report. But before we get too far, let's take a quick peek at the markets and let's look at last week's trade in Google. Google today did a 20-for-1 stock split. So it traded split adjusted this morning. So we'll look at the trade, see how that trade is doing. Before we get too far, though, let's look at my Vix Watch List. We see here that the markets are mixed today. We see the S&P 500 index down about 0.5%. Same with the NASDAQ. Russell 2000 staying flat. Things worth noting is that we have the 10-year below 3, still hanging below 3. We've had an inverted yield curve between the 10 and the 2 for quite some time now. And with that mentioned, that's one of the bigger recessionary things that we are seeing in the marketplace right now. And not a lot of people seem to be talking about that inverted yield curve. We've been in and out, we've been mixed with it. But normally, a lot of people would be talking about recession as soon as you see that inverted yield curve for a sustained period of time. One of the things as far as the economy, some good things is that some of the commodities are coming down. Oil has came down, wheat has came down a little bit. But with that mentioned, we still had a high CPI number last week. Didn't look good. Looks like inflation was, it was larger than expected. And a lot of people are saying that that's going to be because it's a lagging indicator and that the markets are doing a little better than what, as far as inflation is concerned, than what that CPI number was. And once that number came out, we saw the markets came down. Then people kind of got their wits about it and said, well, maybe this is because it's a lagging indicator. The markets came back up. So if we look at the S&P 500 index, the markets can't really decide what they want to do. The VIX index doesn't show a ton of fear. It's been hanging around the 25 level, right around the 200-day moving average. 25 is the new 18 as far as the VIX is concerned. And so we're not seeing a big spike up in implied volatility, implying that there's a lot of nervousness in the marketplace. And on top of it, the VIX of the VIX is actually at lows since the pandemic. We've been hanging down the bottom of the range ever since the pandemic has been, ever since the big downturn since the pandemic hit. And what that is implying is that people aren't using VIX options as protection. They're not willing to pay up for those premiums. The VVIX could be as high in more volatile times, which is kind of weird to say, but in more volatile times, we'll see the VIX index be as high as 140, 120. I think the median range, 200-day moving average, is right around 110, 115, right in that range. So we are definitely on the low end of the spectrum as far as the VVIX is concerned. So once again, mixed messages as far as the marketplace is concerned. Some people are implying that we're already in a recession, even though we have record lows in unemployment. And some people are saying we're not there yet. And we're hoping that the Fed's actions will keep us from getting there. Okay, so we see chop. That's what the marketplace is showing. One thing that did get mentioned today that I've heard from a few of the analysts out there is that they're pointing out the fact that it's been a long time since we've gotten above the 200-day moving average. And that's just solidifying that we're in a bear market. And if you've been looking at your accounts, you probably know, if you didn't bail on the marketplace, that we are definitely in a bear market right now. Portfolios are getting hurt by that, but we had a long way to go before we would be above that 200-day moving average. We did have a little bit of good things to talk about in that we did bust through the 20-day moving average. It was nice to see that turn and actually try to get that golden cross where the 20-day moves above the 50-day moving average. But right now, all I'm seeing in the marketplace is chop. And it makes it very hard to decide what underlyings we want to try to talk about on the stock play of the day. We see things like GameStop coming out announcing a split, stock skyrockets. Google comes out and announces a split and the stock goes down. Just weird things are happening in this marketplace. We're saying that there's a flight to quality, but then things like that are still happening. So it's been a very tough marketplace to try to decide, what underlyings we would want to trade. It's definitely a stock picker's market, but there are still some head scratchers that are going on as far as the marketplace is concerned. All right, so let's go back and let's look at the Google trade. So we're going to start by just looking at the Ally Invest option chains on Google. When we looked at the trade last week, Google was trading at $2,310, 20-for-1 stock split. It opened somewhere right around 111 today, was up on the open, and now we see it down a pretty decent amount too, down about 2.25% on the market. We looked at a longer term, long straddle, and it was really just a speculative trade to play going into the stock split. Amazon had a decent run up going into the split, but then came back down. Kind of hoping for that type of move on Google. It was very speculative trade. And as always, everything's meant to be a paper trade here. We're just trying to learn on stock play of the day. We were talking about the strike prices we wanted to look at. And on a speculative trade, we did a little bit shorter. Well, we actually went out to August. We went out 32 days. And we looked at buying the 119, which when we did this, that was the 2,380, and then selling the 120. So we did that because we wanted a nice round number as far as our strikes are concerned. You see some half point strikes that happened because of the split, and we are 1 point wide. It was, once again, when we started, it was a 20-point wide spread, and now we own 20 of them. We used to own one, now we own 20 this morning. The price of the option contracts have been split, divided by 20. We see that this is trading now for 25 cents. So we're talking about we've lost about half of our value. When we put on the trade, the value was $840. At 20 cents where the midpoint is right now, it would be $400 if we were to sell it and get out of the trade. Personally, it was a speculative trade. I would probably just stay in it and let it ride. There's really nothing that I would do to adjust this trade. But many people that do long spreads have a tendency to say, if I lose half the money, I'm going to get out. So that would imply that if you are using that logic, you would be closing out this trade right now. You'd be selling it, closing it. You have 32 days remaining to expiration. If you do not think it can get to the 120, it can get to that range, which the expected move by this date said that was possible. We're not getting any huge move in the underlying stock, but the move was possible. Numbers have changed. So if you were going to get out and you say, if I lose half my value, I'm going to get out of the trade, now would be the time to do that. Okay, now I'm going to get fancy here. We're going to talk about Twitter. Obviously, it's in the headlines. Elon Musk has made a bid to buy Twitter, and now he's getting cold feet about this, and he wants to get out. A lot of lawsuits. But just to add fun to the mix, Twitter's going to be announcing earnings on Friday before the open. So what are we going to do about this? Well, if I look at the option chains in Twitter, we see that Twitter is up about 1.3% on the day. And the implied volatility, now, July 22nd is Friday. So we see the at the money implied volatility of the most nearest term expiration, I apologize for that, is at about 63% implied. I think there's a lot going on in Twitter. So I'm actually going to do something a little crazy. And I very rarely would do this on an underlying stock. But once again, it is a paper trade. So Twitter's trading at $38. It's not a very expensive stock, which means we're going to have a little bit less expensive option contracts. And we're going to buy an at-the-money straddle. Right now, going into earnings, the most at-the-money option contract, well, it's right, well, 38.50. So we're talking about the expected move around earnings on that Friday is going to be about $2 and let's call it 10 cents. Okay. So that's the expected move around $2.10. That would be if we bought the most at the money call and bought the most at the money put. Our long straddle, which I'm going to pull up inside the options playbook here, is going to speculate that the move could be more than that. And we're going to pay a little bit more. So we're going to go out and we're going to buy the 11-day option contract. We can give a little bit of time for this to play out. And we're going to buy, one second here. We're going to buy the 38 strike. We're going to buy it's trading at about 57% implied. We're going to buy the 38 strike call and the 38 strike put. And we're going to pay $3.12 for that. That means that we're hoping that between the earnings report, all the news that is hitting by the July 29th date, that the stock will move in either direction more than $3. If you don't think that's going to happen, you wouldn't do this trade. I find it interesting. Just in general, I've talked about the volatility of the marketplace, but to see Twitter going into earnings trading at a 56% implied volatility, I just think that the potential for a move, it has nothing to do with Twitter. We're not bullish, we're not bearish, we're just looking for a big move. And that's what a long straddle is. So if we look at the profit and loss calculator on it, this is what we want. We want this move to happen, and we want it to happen sooner than later. We hope that on Friday we get about a $3 move in either direction. And I have no problem legging out of this trade. If we're going to pay $3 for it and I could sell the call or the put for, say, $3.50, don't be looking for the home run. I'll be happy to get out of that trade because there's potential for a whiplash on it. And that's why we're going one more week out in time. We're not just buying the most at the money straddle. And once again, this is a very rare occurrence on the stock play of the day that I would talk about a long straddle ahead of earnings. Just very surprised to see the volatility in Twitter be within this range, right around that, well, the 63% level on the nearest term expiration. So a very speculative trade. I'm going to put it in the right rail. It's going to become the official paper trade this week. And there it is. So we'll call the midpoint. We'll say $3.10. It should be very liquid option contracts. So we're looking to pay for a 1-by-1 long straddle in Twitter ahead of earnings. There, I said it. We're buying the 38 strike call and the 38 strike put, paying $3.10 for it, or $310 plus commission. Max risk will be $310. This is a very speculative trade. And if you do put the trade on and you don't get much of a move on a Friday, we do have some time remaining. And I expect volatilities to obviously come off after earnings. It's normally the case, but there's obviously a pending lawsuit. That lawsuit's going to be around for quite some time, right? We don't know exactly how long it's going to take, but I'm sure it's not going to be a short thing. But our option contracts are expiring on July 29th, so we want to be aware of that. So if by Monday or Tuesday we're not looking to get the move, maybe we just close out our position and we move on. But we do have time for this to play out. We want a little bit longer looking at the July 29th expiration. All right, that's it for this episode of Stock Play of the Day. Please click subscribe, ring the bell, and we'll see you this coming up Tuesday for the next Stock Play of the Day. Thanks for coming, everyone.